Sunday, 9/15 of 2013, and the bulls have come back from the August correction that we had called for. Not only that, we've had a 2 week rally, a 4 day light holiday week here. They continued that rally above the 10 week simple moving average and above the 20 week moving average right here. So basically, we're going to see on the S&P where that wall of resistance will come up right below that 1700 level. One of the things about September is that the bull in the high frequency model, in the exchange model itself, so far we have a split September, it looks like, and September, for the remaining calendar month of September, things are going to become much more volatile. They have the FOMC. Are they going to taper? The thing in Syria. There's a lot of headwinds that are ahead of the market. One of the things that we'll be looking at with it is the 1700 put that's in the money. It's a monthly regular October regular 1700 right up here. Okay. So basically, these are very deflated. We traded these up. This was a huge trade when we had this monthly August that sold down. We were extremely overbought up here. This is that 10-day counter rally. 2 weeks of September have been very good for the counter rally. We're going to look at the wall of resistance on that S&P 500 along with trading the S&P 500 put options, and so the 1700 put. We're also going to be looking at the this particular put option right here. This one that we're looking at over here is a 1690 put, because that is where the wall of resistance is on the SPX at the moment, on the S&P 500. As we can see, 1690. It hasn't been able to close above that. These are daily simple moving averages on a daily chart, and this is what the S&P looks like right here. This is that counter rally, that slow grind higher. So in the short term, for the remaining calendar month, we are going to see increased volatility from the original August correction, and this 1690 put that was up here at $72.50. This is how big this paid the last time we did it. It went 4 weeks straight up. They got inflated. They had to come down. There had to be a bull rally to bring these back down. So now that this process has taken its course, we're a buyer of the 1690 put, the 1700 put in the money. Not only that, the 1680 put, which I will show next on the S&P. Here it is. 1680 put, calendar monthly regular put, is super deflated. But look at the great move that they had when we had the August correction that we called for in the S&P. It was time to be short. It was time to own puts. It was time to have VIX calls as well. So that was a huge move. It was time to sell. They've taken the high of this contract slightly at $65 at its peak, down to $23.80. Once again, the volatility, yes, it's very bullish that you're above the 10-week moving average on this counter relief rally and above the 20-week. That's all bull, believe me. But we're coming up to the major wall of resistance, and this was that August correction. We were overbought. Well, we're overbought now. Not nearly as overbought as we were over here, but we're going to come up and hit that wall of resistance. We will do the very same trades that we did here on all three contracts: 1680 put regular October, 1690 put, and 1700 put in the money. Once again, we always take great pride in ourselves buying wholesale. People that own put options, they never know when to sell out of them. Just recently, in the last 2 weeks of this big counter rally, see the 2 week counter rally right here in the S&P 500, and they took these from $60 down to $23. Time to get in again, and time to play the next reversal on the S&P, and time to make that big money on all of the put options across the board.